Ladies and gentlemen, it's a real pleasure to be with you today in the context of the annual Greek Government Roundtable. I'm Vassilis Kostoulas, and I will contribute to our discussion on the score, that is, the performance of the Greek economy. The speakers of this panel are people who follow the issue very closely, and that's why they're here. Without further ado, allow me to welcome Declan Costello, Deputy Director General for the Economic and Financial Affairs of the European Commission, Martin Bijsterbosch, Mission Chief of the European Central Bank for Greece, Colin Ellis, Global Credit Strategist of Moody's Investor Service, and Dimitrios Tsakonas, Director General of the Public Debt Management Agency. Compared to the period of crisis management in the recent past, a positive narrative accompanies the Greek economy today, which is now perhaps at an even more demanding stage, as it is moving from reforms of survival to reforms of upgrading the standard of living, not an easy task. In this sense, one might say, Greece is now faced with itself, with its real potential. Against this background, I believe, each speaker will start with a few opening remarks, and then we will move on to a brief discussion. Declan, let's start with you.
Thank you, and good morning, everybody. Now, one has to be positive about the performance of the Greek economy and also the prospects for the Greek economy. Now, Greece recovered quickly and very strongly from COVID and the shock of the energy shock. Growth today, or last year, and our projections into the future are 2% in real terms going forward, maybe a little bit higher, but substantially higher than what we're seeing in other euro area countries. So the process of real convergence is underway. If I look at almost every single economic indicator, whether it's fiscal balances, whether it's employment, unemployment, the banking sector, virtually all of the indicators are all pointing in the right direction. So again, one has to be positive about the performance and prospects. Obviously, there are legacy problems and issues that remain from the financial crisis period. And of course, Greece is affected by the mega challenges or trends affecting everybody, whether it's aging populations, climate change, global fragmentation, etc. So I think the potential is, of course, huge. Productivity levels per capita in Greece remain substantially below what we see in other European countries. And I think that's probably the core challenge facing Greece to catch up there. If we look at the labor market participation rates are about 68% in total, substantially below 75% average, what we see in the EU as a whole. And for women, the gap is even higher, 50% participation for women compared to 70% in the EU as a whole. So I think really the agenda is the potential is huge, performance is good, prospects are good, potential is huge.
You seem quite satisfied. This is only good. Martin, your turn.
Thanks very much, and thanks for inviting me once again. I totally agree with what Declan just said. I mean, there's been a lot of talk about Greece's economic achievements. I fully agree with those. GDP growth has been above the euro area in the last few years. The banking sector has been able to offload most of its NPLs. It's profitable again. Public debt to GDP ratio has been coming down significantly, and all that has been supported by structural reform. So I think Greece deserves praise for that and has been praised for that, and rightly so. What I would like to do is to focus on a few remaining challenges. Let me mention three here, and then I'll stop. First challenge, medium-term growth. We know that in many, say, developed economies, in the next few decades, economic growth is going to be below historical averages. And when you look at the aging report, the report on the Commission's website, published earlier this year, that looks ahead at the long term, that report shows that GDP growth in Greece is going to decline to something like 1% per year over the next decades. And I think that there, especially the demographic outlook, is a particular concern everywhere, but especially in Greece. Eurostat projects the Greek population to decline by something like a quarter over the next 5 decades. And the working age population is going to decline substantially more than that. So I think that's a key challenge. And we need structural reforms that boost productivity to support that catching up process that was mentioned, one of the key challenges. So these are the type of things that have been discussed before. Things like improving the business environment, upgrading education, ensuring competition in goods and services, making sure there's enough competition, making Greece an attractive place to invest and to innovate. So these things are needed. I think is the key challenge there is to close that investment gap that still exists vis-a-vis the rest of Europe without creating unsustainable external deficits. Second challenge, financial sector. Banks have done a great job in reducing NPLs, supported also by key financial sector reforms. I think the key priorities remain kind of as they are. There's still some further way to go. I think a strong capital base is a key priority. But as banks were kind of addressing those legacy issues, new challenges have emerged. And they've been mentioned. And some of those challenges, some of those risks are materializing as we speak. Climate, geopolitical risks, they need to be addressed. And it's challenging to address legacy issues and new risks at the same time. So that's another challenge that I see. And outside of the banking system, there's still that chunk of non-performing debt that has been transferred to credit servicing companies that remains a burden on firms and households. There's another issue that deserves attention. Third and finally, public debt. Public debt as a share of GDP has been coming down impressively, so very good progress, but of course it remains high. High public debt means that the government has less room for maneuver to respond to economic downturns. So and that is an important thing to keep in mind. So there, our view is that we need several years of primary surpluses to ensure the sustainability of that. It's not the only thing. There's also there a need. Policies can also contribute, growth-friendly policies, fiscal structural policies that boost productivity, that boost investment, can certainly also help to ensure that sustainability of the public finances. And the RRF, importantly, can help there as well. So to conclude, I think the score of the Greek economy, as the title of this session is, I think the score is very good. It's improving. But we must also acknowledge that some crisis legacies will take more time to address, and new challenges have emerged. Climate, demographics, debt, both private and public, are key issues that need to be tackled. So as we have now moved out of, say, the post-crisis stabilization phase, I think the key emphasis is now, and should now be, on the structural features of the Greek economy.
Thank you, Martin. Balanced message from the side of the ECB. Colin, your opening remarks.
Thank you very much, Vassilis, and hello, everybody. It's wonderful to be back here at Laganisi. You keep inviting me back, and I'll keep coming as long as that happens. I struggle to find a lot of disagreement, honestly. Whether that's a good thing or bad thing, that I can't separate myself from the Commission.
This would be a problem for the discussion, but I will help.
Yep. Maybe I'll just reframe it in a couple of ways. So one of the really impressive things beyond what we've seen in the debt profile so far is when it comes to implementing structural reforms over the past 8 or 9 years, I think Greece really stands out as having done that very impressively. And that's one of the reasons why it's at the front of the queue with things like the RRF and meeting the targets and getting the disbursements there. I think Greece is absolutely reaping the benefits of most of its debt being financed at, frankly, very concessional rates, because most of the outstanding public debt stock is still owed to, well, it's pretty close. A lot of it is still owed to official sector institutions. We know those interest rates are very low. They're locked in for a long time. The maturity is very long. That's a key strength, and it has given the government a bit more wiggle room versus other people who are funding themselves on markets. And at the current rating level, which I suspect we might come back to, Greece has a pretty high wealth level. Per capita incomes actually among the BA-rated universe, where we currently have Greece, are pretty high. But the challenges are everything that we've already heard about. There's more reform needed. People today have been talking about the judicial system, making it easier to do business. One of the great things of coming here and listening to people and talking to people is actually seeing that impetus continue to be there, not just from the business community, but also from the politicians. That drive to continue the reforms. And the reality is pretty much as Declan said, I think. There are some really big legacy issues that we are still working through. I think it took Odysseus 10 years to get home after the fall of Troy. We're talking at least 4, maybe 5 Odysseys to get to a point where Greece is fully funded on financial markets and has met and repaid all of its commitments to European organizations. And that's just a long time. But the progress so far has been great. And to answer the question directly, the score of the Greek economy.
You can give a number if you like.
Yeah, I'm going to give you a rating, if that's okay, because the way our sovereign rating scheme works, we go from AAA down to C. We have individual scores on individual factors that we look at. And at the moment, we rate the Greek economy, if you want to think about it that way, as a Baa1. Okay? We think it's strong. That's a relative strength of the economy. It's just that there are other things as well that matter for credit, which we might come back to.
Thank you, Colin. Last but not least, Dimitrios Tsakonas.
Thank you very much for inviting me here and for being with all this. The panel here, very interesting and very challenging for me. So I'm not going to be focused on the past. I want to speak about the future. And speaking about future, I want to tell you that we have set this in PDMA in the Ministry of Finance and my political supervisors, the previous ones, the current ones, and I hope the future ones, 4 ambitious targets. The first one has to do with the primary surpluses. There's an agreement in place, not a written one, but a very strong, a commitment of Greece with European institutions, with the Greek and European taxpayer, that from 2012 onwards, at some point of time, debt should not create debt. That means that we need to deliver primary surpluses that should be equal, if not higher, to the actual annual interest payments. The second ambitious target that should be set is as far as the rating is concerned. I'm going to revert because I have my beloved Colin here. The target should be not the BBB- status, i.e. the investment grade. It's just the first step. The target should be the A+, i.e. the level, as far as the rating is concerned, that we used to have before deciding to jump from the roof, i.e. before 2009. The third target, which is ambitious also, is as far as the spreads is concerned. Yes, indeed, we have tightened the spread, and compared to the assumptions that have been taken into account for the debt sustainability analysis, i.e. 200 basis points, now we have reached the 105, 106 even, or despite the volatile environment due to European elections, French elections, etc., etc. But the target should be being tighter, close to Portugal, if not even tighter, because Portugal is a similar country in all aspects with Greece. And the fourth target has to do with the so-called net debt figure. Everybody speaks about, in relative terms, as far as the debt is concerned. Debt to GDP ratio, etc., etc. We have a more ambitious target, the net debt figure being reduced in absolute terms. The definition of this figure is the outstanding amount of debt, general government debt, minus the general government cash reserves, plus whatever the arrears exists. So I need to inform you that this target has already been achieved last year, and we believe very strongly that will be achieved even this year and the next years and the years to come. So, yes, I want to focus on what we call future, rather speaking about the past, which was a nasty one, and I don't want to remember.
Thank you, Dimitris. Ambitious targets for the Greek debt. Declan, how much money is the Greek state entitled to spend? What does the new fiscal framework of the Eurozone mean for Greece?
Okay, so the Commission actually sent to all member states our quantitative estimates of what is required to ensure debt sustainability about 10 days ago. And the good news for Greece is, yes, the stock of debt is high, but Greece has a fairly low deficit, and very importantly, and as mentioned by Dimitrios, has actually a fairly significant primary surplus, which is projected to increase going forward. So in fact, now the new fiscal rules have a big benefit in the sense that it's a much more risk-based approach. So we can have a much more tailored assessment and tailored recommendations to countries and avoid a one-size-fits-all.
More flexibility.
More flexibility in the sense of catering for where the real fiscal sustainability risks lie, okay? And the risks in Greece are the high stock of debt. But actually, the primary surplus is actually close to what is actually required. So the discussion that we will have with Greece in the coming months on their medium-term plan is not about fiscal consolidation. It's not a debate on what extra consolidation is needed to ensure fiscal sustainability. It's really about the composition of the budget going forward. How can the tax system be made more growth-friendly? Can expenditures what type of expenditures, and in particular, can expenditures be focused more on the critical investments which are needed for whatever, the climate challenge, raising the skills.
So we will have a more structural approach, you mean?
So, I mean, basically, I'm expecting actually a very straightforward discussion with the Greek authorities, again, really about the composition of the budget, but this is not going to be a difficult debate about fiscal consolidation because the starting underlying position is very, very good. So the Commission, 10 days ago, we recommended that 7 member states be put into an excessive deficit position, okay? Greece was not on that list. We actually downgraded our assessment of the macroeconomic balances for Greece because of the progress which has been made. So to be honest, I have a list in my head of where the countries which I think we will have very difficult conversations on the fiscal plans going forward.
As always.
Greece isn't remotely close to being on that list.
All right. Martin, in Greece, the banks apply a high interest rate margin, which means a large difference between the interest rate on loans and the interest rate on deposits. This is positive for their balance sheets, but not so good for the real economy. Is a better balance needed here?
Well, I think when you look at that, I think it's first of all, it's important to keep in mind that Greece is one of the jurisdictions where the loan book of banks consists primarily of floating interest rates, floating interest rate loans. So when monetary policy interest rates are increased, that implies that the pass-through into bank lending rates in those jurisdictions is relatively quick and strong. And that's also something we've seen. We've seen bank lending rates going up. Deposit rates have gone up less. Depends a little bit on the type of deposits you look at. Of course, there's also the liquidity situation of the banks that plays a role. So it's important to look at that from a dynamic perspective, I think. What I think is important is to keep the setting of interest rates of bank lending rates to banks. That's their job. It's a complex thing. There are many factors that feed into that. There's risks. There are all kinds of factors, and banks are well placed to assess those risks and to set those interest rates. Of course, that assumes that there is, say, a healthy degree of competition between banks. That means that, of course, when customers are not happy with the conditions that are offered by banks, that they have a genuine alternative, that they can go somewhere else if they want to. I think that's an important principle. Whether that's the case is not up to me to assess. That's a question for the competition authority. But as I said, I think it's important to look at that from a dynamic perspective. That margin, that evolves over time. It's not a static thing.
All right, Colin, does the fact that Greece has already been rated with investment grade by other rating agencies add or does it remove pressure from Moody's, if you feel any pressure?
There are other rating agencies?
This is what I heard.
Never heard of them. No, I'm in charge of the group at Moody's for my sins, which measures our rating performance. And we have a number of metrics that we look at in terms of the predictive power of ratings for defaults, ratings volatility and smoothness and reversals and things like that. But all of those measures are internal. They're focused on us. They're focused on our own performance. So the challenge for me is always, have we got the rating right? It's never really a question of, do we need to follow someone else? And I think, frankly, I think that's the way it should be, because if you have, I'm a great believer in people forming their individual judgments, but also in the power of committees to make better decisions than individuals. It would be lovely if everybody at Moody's just did what I asked them to when I asked them to do it. But I'll be totally honest with you, it doesn't work that way. And every time we move a rating, every time we have a discussion, it's a genuine discussion. And it's bringing together people with different perspectives, different backgrounds to try and find, ultimately, a rating we can, most of us at least, get behind. And that very process by its nature involves judgment calls. And sometimes we'll make a different judgment call that somebody else might make. The gap at the moment, we're talking about one notch. I know lots of people get obsessed with investment grade versus non-investment grade. I think I've made this point before, but for me, the gap between what we call Baa3 and Ba1, in terms of our default performance, and if you look at the data we publish on what that means for cumulative default rates over time or loss rates over time, that gap is smaller than the gap between a Ba3 rating and a B1 rating. So with the BA rating at the moment, we are signaling that we do not think Greece faces significant credit risk. We think it's a strong credit. But of course, I understand, there are still a few mechanistic things in the market where if we were to move to Baa3, that might have some positive effect.
You still need time, as far as I understand.
Well, we do get accused of being slow sometimes in more than one way, more than one manner. I mean, we're also constrained by, EU regulation, right? Because we want to be good citizens, and credit rating agencies today, for very, very good reasons, face a totally different regulatory environment to what they had in 2005, for really good reasons that I understand. But one of the changes that we face is there's only 2 dates a year where we are supposed to take sovereign rating actions in Europe, precisely so that those actions are more predictable. The next date for Greece is the 13th of September of this year. I don't know what we'll do, because as I said, people don't do what I tell them. We genuinely have discussions. I do have the power to make us have a discussion at that date. I don't think I'll need to use that, because I think we'll have a discussion. And my hunch is it will be a much happier Friday the 13th than the movie franchise. But I don't know. At the moment, we have a stable outlook, but you can see in our research, we're aware of the positive developments. So we might do nothing. We might assign a positive outlook. We might do something else. I don't know. But we want to be following that calendar wherever we can.
Dimitrios, why is it important that Greece receives the investor grade from Moody's as well? And you can look at Colin while we're answering if you
Yeah. Initially, and based on information and studies that our primary dealers did, i.e. a year ago almost, there was, let's say, a report, a joint one, that the primary dealers considered, having examined, let's say, the issue or the reaction of the market after the investment grade status achievement, and they said, or at least this is what I have in my mind, that in case that 2 out of 3 important rating agencies, in the group of which also Moody's belongs, in case that Greece receives the investment grade status by 2 out of 3, then the so-called passive investors would join, let's say, or will decide, and the potential additional appetite for Greek government securities would be something between 6 and 10 billion. In case that the third one provides or will provide the rating, the desirable rating, most probably this, let's say, amount will be the double one, i.e. something between 14 to 20. Now, if you ask me, what we have seen so far, investors consider that Greek government bonds have already received the investment grade status even by Moody's. Everything is priced in. And there are concrete elements that I can prove this, i.e. the last two bond issuances that we did through syndications, we faced and we saw that we had an expansion of the investors base by 50%. The order books were extremely high as far as the orders is concerned, the total amount of the orders. We achieved, or we had the biggest issued amounts for both the 10-year and 30-year one. The 30-year, very challenging, let's say, and very tricky, bond issuance and maturity. Now, if you ask me, because I don't want to avoid, or I want to complete my answer, I do believe in investors' views. Let's take as an example the 30-year bond issuance. We issue this bond in an extremely volatile environment, rockets, missiles, etc., between Israelis and Iranians. We had the biggest ever order book. We issued a $3 billion bond issuance. The allocation was extremely good as far as the real money investors is concerned allocation. And we didn't have in place PPP. That means that investors voted that Greek government securities deserves having the BBB- status provided by all rating agencies. So everybody is convinced. The missing part is Moody's to be convinced. I think it's a matter of time. On the other side, I'm not going to put a lot of pressure on my friend Colin.
That's clear. Declan, very quickly actually. In Greece, the question is often raised as to whether the high prices of products are now a result of either greed inflation on the part of businesses or malfunction of the Greek market to the extent that it doesn't promote competition. What are your thoughts here?
Well, I think the good news is that I think the annual inflation rates from May and June are at 2.4%, so it's getting close to the ECB target. I think there is some component of core inflation, which indeed comes from regulatory barriers and let's say the absence of competition in some sectors. But I think that is not the main explanatory factor. Obviously, there's been the impact of energy prices. There have been supply-side bottlenecks. I think that is
even today.
Yeah. Well, they're obviously receding. And to be honest, I mean, when we look at inflation in Greece and I look at things like wage developments, sure, nominal wages have increased also in the public sector, also the minimum wage. But I mean, that has to be judged against or seen against the context of real wage declines over the past decade, and of course with inflation. So we really don't see any evidence that wages are sort of pushing or driving inflation. If you look at our indicators of competitiveness, what we see is we don't see a loss of cost competitiveness of Greece. We see gains in export market share across the world. So I think what we're really seeing is that if there is a competitiveness issue in Greece, it's really non-price competitiveness issues. So it's the regulatory issues we refer to. I think there obviously are some issues related to access to finance, some legacy issues, which Martin mentioned. And then I think a further issue, which will be increasingly important going forward, is on the labor markets and skills, and the need to sort of...
All right.
Thank you.
Thank you. Martin, the ECB is on course to reverse monetary policy. How should the Greek banks prepare for the forthcoming reduction in the interest rates, if and when it is confirmed in practice?
I think that essentially Greek banks should continue to do what they have been doing. And I think it's prudent to assume that profitability will not always remain where it is now. Of course, it also hinges on the ability of banks to expand their loan portfolio, right? And it's not just the margins, but also the volume of new loans and the ability of banks to do that in a sustainable way, allocating that credit in a sound way. So I think it's prudent to prepare for those scenarios. It's also important to prepare for a scenario in which, say, geopolitics and will create more macro volatility. So it's important to have sound buffers there, work on capital, strengthen capital, work further on digitalization. So I think that these are the type of things that banks should continue doing.
All right.
Things
yeah. Yes, have you finished?
No, that's it.
Okay. Colin, do you think that the international environment at this juncture has a positive or a negative effect to the Greek bonds?
I would actually say it's quite positive. And it's a bit weird, and I'll have to explain it. But, Martin is absolutely right. I'm spending far more of my time on geopolitics at the moment across the whole region than on economics and finance, because macro is almost starting to get a bit boring again. Inflation's almost back at target. Rates will be on the way down. But the thing that geopolitical risk does, or put it another way, the thing that risky geopolitics from countries does, is it raises uncertainty. And that means investors demand higher risk premia. It means the option value of weighting jumps. And so where you have pockets of certainty, they suddenly become relatively very attractive. And the thing about Greece that we've talked about repeatedly, I think we all agree on, is there is a lot of certainty about the trajectory for Greek refinancing needs over the next decade. We're on this very long odyssey, but we know that that financing is already in place. We know it's a very gradual process of having to come back and basically refinance some of the official sector obligations on the market over a long period of time. And as long as Greece is meeting its fiscal requirements, which it is, in terms of the primary surplus basically being where it needs to be. So, the fiscal envelope is set. There are plenty of other countries where I'd love to see that, including my own. That's a very strong and stable picture, provided everybody lives up to their obligations.
All right.
But they have been. Right. So I think that's a positive.
Dimitrios, as the manager of the Greek debt, what is your greatest fear?
After 15 years deeply under the water, nothing. I'm afraid of nothing. Yeah, I think that due to the fact that Greece is proactive in all aspects, let me tell you that also given the solidarity provided by European institutions, the Greek and the European taxpayer, and I take this opportunity to say a big thank to all of these institutions and people. I think that now, that's why I wanted to start by elaborating and discussing about the future. Our political supervisors, my colleagues, my predecessors, and myself, we tried very hard. We have tried very hard since 2012, and we provided a window opportunity of at least one generation's time, i.e. a breathing space for the Greek society, the Greek political system, the Greek economy, to rethink, if you allow me to say, about our future. Now, since we have immunized all risks as far as the numerator of our problem is concerned, i.e. the Greek public debt, zero interest rate exposure, zero inflation exposure, zero FX exposure, since we have in place a very favorable structure of the Greek public debt, extended maturity, 20 years, our debt looks like a bond that matures in 20 years' time with a bullet repayment, with 1.5%, less than 1.5% coupon in fixed rate, full in fixed rate. So we have nothing to be afraid of.
All right. Thank you, Dimitris. A last question for Declan. There is an impression lately that probably there are delays in Greece in terms of absorption of the resources of the recovery fund. I'm mainly referring to the speed of disbursement to businesses. What is the picture that you get?
Well, I mean, I think the overall, excuse me, the overall picture in the implementation is pretty good. Greece received in total, I think, 36 billion euros under the recovery facility, half in the form of grants, half in the form of loans. The implementation on the loan side, most of which is going to reduce the borrowing costs through the commercial banks, is actually ahead of schedule. We have processed, we're in the process of looking at the fourth payment request on the grants, and we hope we will be able to finalize that probably in October, around October. And then we will move quickly to the fifth payment request. So in terms of submitting the requests, it's not quite on schedule, but it's picking up, and it's one of the leading countries. It is true that there have been some delays in the actual absorption of public investments, partly because of the impact of the energy crisis, inflation, supply-side bottlenecks. But I know the government is working intensively on that. To be fair, not all of some of these delays are due to factors outside of the control of the government. There is, occasionally litigation in courts. There have been supply-side bottlenecks. So I think it's a bit behind schedule, but I think we're confident that every effort is being made to accelerate. Can I just maybe come back to one point that Colin mentioned about having the factors, the elements of certainty going forward? I think there's one additional element I would like to add, and that's the certainty about the scale of funding to support investment that will come from the EU. So I mentioned there is 36 billion from grants and loans through the ORF, which is somewhere between 16 and 17% of GDP. There is also 21 billion euros from cohesion funds. So when you add that up, that adds up to somewhere between 25 and 26% of GDP, okay? And 18% of that is in the form of grants, so it's not, it's a transfer to Greece. Now, I don't have the exact figure on how much has been transferred to Greece. It might be 5-6 percentage points of GDP. So there is 12, 13 percentage points of GDP available to support investment over the coming years for Greece, over the coming decade. And I think that, to me, is another source of certainty. So, Colin, no pressure. If you want to come back, you know what you have to do. So it's genuine uncertainty. And it also means that what we were discussing, the medium-term fiscal plan, I think we can have those discussions, which, they're challenging discussions on the composition of public finances, but in the knowledge that there will be material support for investment coming from the EU.
All right. Unfortunately, we don't have more time. Thanks so much for your participation in this panel. Thanks for the audience for its attention. I think you will hear more about the Greek debt in the next panel. Thank you.